Welcome everyone to our first webinar in our M&A advisory series, Planning and Due Diligence. Before we get started, I want to take care of some housekeeping items. You can maximize or minimize the webinar pane during the presentation by using the red and orange arrow buttons. During the webinar, we definitely encourage you to ask questions. In the webinar pane, you'll see a questions box that you can use to type in your questions and hit submit. And then our presenters will be answering those questions as time allows at the end of the presentation. Second, I want to make sure everyone has good audio quality. If you're using a telephone, please select the phone call audio option. If you're on your computer, please select the computer audio option. And then as a reminder, we definitely want to make sure you're following us on social media at Armino LLP. We're on Facebook, Twitter, Instagram, and LinkedIn. And now I'd like to introduce our presenters. We have Ricardo Martinez. Ricardo has more than 20 years of experience, including 12 years conducting audit advisory services at the Big Four. He works closely with CFOs, controllers, boards of directors, audit committees, and various industries, including hardware, software, online digital media, e-commerce, and life services. Oh, life science, sorry. And then we also have Dean Cuyambo. After 12 years with Armino in our audit department, Dean transitioned to our chief relationship builder for the firm. He helps numerous private, public, and nonprofit companies address their tax, audit, and outsourcing accounting needs. And without further ado, I'll pass it off to Ricardo Dean.
All right, Ricardo, we're getting long in the tooth, bud.
I know, seriously. Every time they talk about my years of experience, I always get a little scared.
And I always wanted to be a 20-year person, but now I don't want to be.
I know,
anymore.
exactly.
Anyhow, welcome everyone to our first webinar in our M&A series. You could see that we have a number of topics coming up, and we might even add one towards the end. We're exploring that right now, but we just wanted to walk through all of the different ways that M&A and how M&A is happening and how you can kind of prepare for it. Today we have Ricardo Martinez, who's one of our audit partners, who unfortunately has gone through a good amount of acquisitions himself. When our clients get acquired, it happens all the time. And so we're going to kind of explore that. But just so you see what's going on in the marketplace today, some of the market activities, you could see that buyouts have continued to show strength. I think we're seeing it more and more in our client base, in that strong middle market and large mid-cap companies, up until even the public companies up to with a valuation of $500 million around that sweet spot. We see a lot of acquisitions, and that is backed by a strong IPO market as well, which is bouncing back, as we know. Software companies continue to dominate those VC-backed exits. You can see all of the industries there, but through last year, software had a big play. Ricardo, your clients, where you're seeing a lot?
Yeah, a lot of them are in that space right now where they've gotten significant amount of new investors or have had exits through M&A or through an IPO, have all been typically in that space. And those are the ones that we are seeing that are most successful.
Sure. And then if you go to the graph on the right, the growing number of larger exits completed in 2017, and you see that, yeah, that there's there's a pocket there of the 25 and the 50 million, but even the larger companies, we're starting to see more and more companies exiting greater than $500 million, and we're seeing that and experiencing that, which is kind of setting the table for why we want to do this whole webinar series. Again, more data that is pointing to why we're doing this. And in 2018, it's still there. Even though that maybe not off to the hottest start, I feel like in 2018, the values are strong, and that I feel like maybe we're not doing as many right now because more and more organizations are kind of looking for that perfect price amount. Is that fair to say, Ricardo? Is
right.
The valuations are getting higher and higher?
Right, valuations are getting higher. I think people are being a little bit more strategic about the process that it takes to get to an IPO or an exit, and just making sure that they're prepared properly in order for the rigors of an IPO market, volatility on the public markets, or just dealing with the overall rigors of being a public registrant.
Okay, so with that said, yeah, when we said here, deal count is down a little bit, but we think it's going to pick back up, and we're seeing a lot of it. So with that said, we're going to switch over now and talk about what we want to focus in on today. And it's really, you guys know, Ricardo Martinez is one of our audit partners, and we're going to really focus in on audited financial statements. And what we like to say at Armanino is keeping you due diligence ready. We want to really highlight areas that are challenged during that M&A due diligence process. What does that look like? We all know that revenue is going to get a lot of look. There's a couple different ways there, ARR and EBITDA. Why don't we kind of talk about that really briefly before we kind of jump into revenue? But with regards to the forecasting models, Ricardo, I know that the private equity firms look at ARR, and EBITDA. Why don't you give some insight into that?
Yeah, so ARR is annual recurring revenues, and EBITDA is earnings before income taxes, depreciation, and amortization. Kind of a generic term. There's also some other non-cash items that are added back to adjusted earnings as part of that process. But typically, those are the two models that are used in order to forecast out for M&A or as part of the due diligence, or what buyers would typically focus on. Obviously, the key driver in that is revenue. When you're thinking about an ARR or an EBITDA model, that's really kind of the biggest driver for generating profitability under those two models. So typically a focus area that we hit hard and really focus on as part of the audit, just to make sure that that number can be forecasted properly and accurately as companies look to an M&A either exit or even to a significant investor, or just providing overall numbers and forecasting models to potential buyers or investors.
And you know, just for our people on the line, Ricardo, ARR and EBITDA, when they're using that, is that going to, I assume that's taken helping with the valuation of the company.
Right, overall, yeah, exactly. So those are kind of the two primary drivers to value companies, or typically what we've seen in our area and our technology and software and SaaS space being kind of the primary focus for valuing companies.
Okay, great. Well, when we asked Ricardo, we said, Ricardo, what are the areas that get hammered on the most in due diligence when your clients that you audit get acquired? And Ricardo came back with revenue, equity, taxes, and accruals as the four areas that really just get a whole lot of attention. And so what we wanted to do for the rest of this webinar is kind of highlight what in each of those areas is getting scrutinized, how are they scrutinizing it, things of that nature. So with that said, you know, when you have audited financial statements, the first thing is always revenue that's going to get a lot of attention. So let's jump into that, Ricardo.
Yep.
So go ahead, Ricardo. You know, let's talk about revenue. Let's talk about, you know, what are people when revenue is going to get tested. Let's just give some insight into the overall process. Right. What does it look like? How does it work?
Yeah. So just by way of background, you know, a lot of investors, buyers, or as part of any sort of due diligence, they really want to understand kind of who that audit firm is. And so before we even get to kind of looking at the work papers and discussing these different topics, one of the things that you want to make sure that you have as a organization is industry specialists, somebody who actually understands your industry, somebody or your company, but also the industry that you operate in. There are subtle nuances to the revenue recognition model within a technology-based company. And so ensuring that you actually have a partner that understands that is going to be very important. I'll give you an example. I was on a call with one of my clients, and they were telling me that they were going through a significant investment round by a pretty big buyer. So we got on the phone with their investment banker. We got on the phone with their with the firm that was doing the due diligence, and we got on the phone with the potential buyer. So all three of them started going into our background and trying to understand, okay, how many years of experience do you have overall? And again, I think that's where now I'll take the 20 years instead of not taking the 20 years.
That's fair.
But that's where it's important. The other piece that they focused on is my experience and our firm's experience in technology. How long have we been servicing technology clients, and how long have we been working with them? And how deep of an understanding do we gain by working in that industry? So certainly grilling us on our experience and our expertise, particularly in the technology space. And so we do have the quals to back it up as a firm and as and myself as an audit partner, which really helped in that process. So now we step over to some of the deeper dive topics. The first one being revenue. The reason why it's important, again, is because of what you see on this slide here. What are the things that you need to kind of focus on? What are they going to look at? What are they going to test? Really having an understanding of a company's revenue recognition model is very important. One of the things that I always encourage my clients to do is build out a revenue recognition policy memo that can be provided as part of due diligence, or just as good corporate governance to have for internal documentation. But certainly understanding the revenue recognition process, how it works, multiple element arrangements, if you're in the software world, understanding vendor-specific objective evidence, a fair value, so VSOE, understanding how you're separating the elements, understanding what sort of support you have in order to separate those elements into the different deliverables, and then when that's actually recognized, understanding your contracts, and in particular significant contracts, looking at renewals, or is there anything that's given away for free that really should be evaluated as a potential separate element in the arrangement, rebates, discounts. And then the new trend, obviously, particularly if you're a private company, is understanding the impact of 606. In some cases, in all honesty, I have seen it where it's pretty much a check the box and they just ask, have you done anything with 606? Company answers yes, perfect, we check the box. In other cases, there have been organizations or investors or buyers, or as part of due diligence, that have actually wanted to see a quantitative amount of the impact with respect to 606, or how the company's policies will change with respect to revenue recognition between current GAAP under 605 versus new GAAP under ASC 606. And so we really try to help clients go through that process to make sure that they understand all of these and can speak to it intelligently as if it's their own. And so part of our process as auditors is really to educate our clients to make sure that they understand what they're doing, how they're doing, and not just told what to do.
Got it. So Ricardo, here on this slide, I assume that your potential buyer or large investor is going to look and they're going to want to pull a sample of your contracts, whether those contracts are homogeneous or not. They're going to look at the significant ones, and what are they going to do? They're going to say, okay, we like what you're doing, but we want to dive into the process. So tell us about revenue recognition. Are they going to walk through the process? Do they want to know how it's recorded? Do they want to see the cash receipts? Give us some insight there.
Yeah, so basically, and every time we have this process, we make our work papers available to the individuals doing the due diligence. And so we have a person on our side who sits there and essentially babysits during the work paper review. And that is a technical term, babysitting, I think is what it's called. But in any case, I always ask them after, what were their focused on? What were their questions? And number one is always revenue, and they always deep dive into the revenue. They'll look at our work papers. They'll look at the supporting documentation. They'll look at the revenue recognition policy memo if we have one in the binder. And they really try to understand how that revenue is affected by the work that we've done, looking at it from inception, making sure that it's that there are contracts that exist, going through all the revenue recognition criteria. And again, these guys on the other side are specialists as well, and I think their job is to try to find holes to beat down the valuation a little bit, with revenue being the primary driver in those models that we discussed previously, the ARR and the EBITDA. So they will look at our work papers in much detail, and in fact, I heard a story about a client that went through due diligence, and to the point where the group performing the due diligence actually selected a specific contract out of our revenue testing, and actually had the client walk them through it start to finish to show how that revenue was recognized into the GL. So that's probably the most extreme case that I've heard of somebody going into that much detail, but certainly they'll look at our work papers and focus on the revenue side as well.
Great. Is there any, in today's market, is there any like big bogeys out there, or is it really just knowing the impact of 606 and kind of being able to project that, companies should kind of be prepared for?
Yeah, so it's knowing the impact of 606, and then just making sure that you have a current rev rec policy that's in place that is consistent with current GAAP, but then also understanding what that impact of 606 will do for future revenues. If it's going to, the big thing with 606 is, the devil's in the details there, and there is the potential to actually accelerate revenue recognition for which you won't get any credit for. So, that's another topic. We have a couple webinars on 606 if you ever want to go to our website and look at those, but certainly important to understand what that impact looks like.
And then last thing, Ricardo, if you're being audited, and you have a certain level of comfort, right? You're getting audited, someone's looking at your revenue recognition, and you feel good about that. What if you're not currently being audited right now, but you think, hey, we could be an M&A target? What were some insight you want to share there if you're not being audited and no one's really looked at your revenue file before?
Yeah, that's always a scary part, because I think whenever you go through an audit or a review or even an examination related to revenue, I'll be honest with you, and total transparent, we never give revenue as part of an audit or any of those other types of services. Typically, auditors take revenue away. So the potential is that your revenues are overstated if they've never been audited before, which means if you still go through due diligence with the potential buyer as part of an exit, more likely than not, they'll reduce that revenue as part of that, which is kind of, in some cases, if you don't have an audit, there's really no numbers to stand behind. And you lose some of the leverage that you have in the negotiation process as the buyers firms do their due diligence and will knock it down. So always good recommendation if you do think that you want to get, go through an M&A transaction investment to get some sort of audit or review or even an examination of the revenue cycle.
Great. Okay, next area that we talked about was equity. This is another area where, due diligence likes some focus. Why don't we talk about what is looked at in the equity section?
Yeah, so on the equity side, really understanding who the owners are. The buyers typically want to know what else is out there. Are there any outstanding warrants? Are there any other convertible instruments that are convert prior to or subsequent to a transaction? What sort of debt is outstanding, and how does that actually affect the buyer or the investor? So those are really kind of the focus areas for on the equity side. Now, a lot of this, I will admit, is non-cash when we talk about the accounting treatment for it. But really, for our clients that go through M&A or due diligence with an equity focus, it's really understanding or demonstrating that you have a complete and accurate set of financial statements, both from a cash and a non-cash perspective, that can be provided to the buyer or to the individuals performing the due diligence.
Great. So really here, it's those outstanding warrants and convertible instruments that are the big things that we're looking for here. Got it. Okay. Great. Well, then let's talk about taxes. And we know that we have a whole webinar going to be focusing on taxes as part of the M&A webinar series. But from a financial statement audit perspective, what are we doing with regards to taxes and accruals and things of that nature?
Yeah, so part of the auditor's responsibility, and part of mine personally that I like to do, is just make sure that we're corralling all of the potential issues. So even though I'm not a tax specialist, I know enough to be dangerous, and I know that there are some focal points that buyers and investors and due diligence firms really focus on. So on the tax side, it's really looking at change in ownership and understanding what the impact is on your net operating losses, understanding truly what your deferred taxes are, certainly knowing what your tax provision looks like, understanding any sort of R&D tax credits that are involved as well. If you have international operations, transfer pricing, in the technology space, you definitely want to understand what the impact is of sales taxes either way. Very, very important, because I have heard of stories, thankfully it hasn't happened to any of my clients, but I have heard of stories where certain companies are surprised because as they go through due diligence, it turns out that there's a sales tax accrual that's pretty significant that needs to be accrued on the books, which obviously, if we have the credit on the accrual side, we're going to have a debit on the expense side, which ends up affecting, the purchase accounting. And so we really try to make sure that we're corralling all of these potential issues before they actually arise. and working with our clients to understand or get them prepared to discuss these.
Great. So really that holistic look here.
Right.
Okay. On the accrual side, is there any accruals that we need to be wary of? Obviously for financial statements, it's always the completeness of accruals, and it's not exactly what we see, but what we don't see.
Right,
So
right.
give us some insight here.
Yeah, it's just really going through a completeness and accuracy discussion and process with our clients to make sure that everything is captured potentially out there. Any sort of legal accruals, any sort of, we just talked about sales tax accruals, kind of along the lines of deferred revenue, making sure all of that is correct, as part of that revenue process. So looking at your accruals is very important in terms of completeness and accuracy perspective. Again, understanding that if EBITDA is going to be the primary focus, your accruals present a potential adjustment as part of that, with a corresponding expense being recorded. The other thing to be aware of too is capitalized software development costs, and making sure that you actually understand and have a response for cap software and whether or not you're capitalizing it. If you're not capitalizing it, why are you not capitalizing it? And I've seen that come up a couple times during M&A.
And with regards to accruals, I think the big thing here, Ricardo, is if you are being currently audited or have been audited, you have a sense of comfort, right?
Right.
But if you haven't, and this is an area that that could give you a little bit of a headache, right? Is the fact of how complete are your accruals?
Right. You could be a little surprised. I mean, again, we talked about, as part of an audit or review or whatnot, typically we take revenue away. In the cases where there's accruals, typically we book additional accruals on the books. We don't reduce accruals. A lot of times for those that haven't been audited before, we find that their accruals are not complete, which means that they're understated, which means that their expenses are understated, which then if you kind of flow that through, it means that, this is going to affect EBITDA and have a negative impact as part of the purchase accounting.
Well, that's not very fun, Ricardo. Nobody likes somebody who's taking away revenue and adding,
That's right. That's
adding
why people
expenses.
hate auditors.
Well, with that said, though, that kind of makes me feel like, the more ahead of the curve you can get, right? In terms of making sure your financial statements are in good standing and at a point of reliability, you're going to be more ahead of the curve in any kind of transaction.
Right. We're hearing more and more of that lately. Had a couple opportunities recently where there hasn't been an audit requirement, but the company has just been looking to get kind of due diligence ready. And so I really applaud that type of effort to really kind of just do a gut check and just see where you're at and make sure that your books are ready at any point in time.
Great. I mean, I do like to tell the story of a company who asked to meet with us and said that they really wanted to grow and wanted to get some audited financial statements. And we were able to issue 3 audit reports in 16 months, kind of get them caught up and get their books in decent shape. And all of a sudden they got an unsolicited offer for $305 million. And that person who met with us did all right. That transaction went through with no adjustments to purchase price. So he was a pretty happy camper that his small little company got acquired and went through there successfully. So that's always the story that we like to have for our clients. With that said, I think we do have a couple questions, Ricardo, and one of them says, do different investors measure revenue churn differently, or is there more of a standard?
Yeah, there's not really a standard with a lot of the metrics, kind of in particular in the technology space. I mean, it's really kind of a policy election as to how you're actually going to calculate that or determine that. I would document it though, and just make sure that you're providing backup for how you're actually coming up with those numbers on the churn.
Great. And I just got one off the top of head here. So you said that, definitely with regards to completeness of accruals, and we normally book more, and revenue, unfortunately, we take it away. Is there any specific area within the revenue where we're taking, where we're saying, oh gosh, you've accelerated recognition and we need to slow that down? Is there a specific area in there that people need to be looking out for? Like, hey, if you have this type of contract and you might be recording it a little too early, just for people on the line to say, oh man, maybe the light bulb goes off and they think that, they need to make a call.
Right. So a couple points there. One is that, excuse me, a lot of times people will just book based off of cash receipts in some cases, or they'll book based off of what's actually stated on the invoice. If you actually have multiple element arrangements, meaning you're selling a subscription with professional services, with training, you technically fall into the multiple element arrangement accounting, which means it's not as easy as it seems to just book what you have on the invoice and record that and then recognize it. So there is a process to be had if you are a multiple element arrangement or even a software company, pure software, in order to go through and be compliant with the standards. So don't just take for granted that, hey, whatever I have in my invoice, it's really easy. And typically when I hear that, oh, our revenue is really easy, that's the kiss of death, because then I know it's not. And that's where I find typically the most problems is in those types of companies. So, and then just one other point to add to, when we kind of talk about how to be prepared and be due diligence ready, it really is having a good relationship with your partners. One of the things that I and we as audit partners here in Armanino strive for is really to be in constant contact with our clients throughout the year. That really helps. And it's not just meeting with your auditor on, once a year, one time, and then you don't hear from them for another 9 months. In order to truly be due diligence ready, you need to make sure that you're in contact, that you're providing significant unusual contracts to your audit partner to make sure that they're actually providing you with relevant and timely information. I'll give you just one quick example before I get back to you, Dean. Is I had a company, and we typically are in contact with them, helping them with any sort of transaction that happens during the year. We come in and do an audit usually in Q1, and then we'll do some interim work in Q4, calendar year in company, of course. And because we're in contact with them, we have been helping them record some significant contracts, some debt equity stuff, in Q2. Q3 comes up, so before we're starting interim, and lo and behold, there's an actual significant investor who wants to perform some due diligence, and they want to look at not only the audited financial statements, but year-to-date financial information. And so because we were able to help them throughout the year, they got a very favorable valuation as part of that process. So that's very, very important, just to make sure you have a good relationship with your audit firm and your audit partner and manager, that you're comfortable reaching out to them throughout the year to get help with real-time transactions.
Awesome. Thanks so much, Ricardo. Again, everyone, today our focus was planning from an audit perspective. Our next topic is going to be quality of earnings on September 18th. What is the difference between an audit report and a quality of earnings report? How can you leverage quality of earnings, whether you're selling your company or buying your company? And that's next September 18th. We look forward for part 2 of this webinar series. And if you guys have any questions, please feel free to reach out. We're here for you. Thanks a lot.